Silver sits at $67 on paper, but the physical market has already decoupled. Dealers in Shanghai quote 12 to 15% premiums, pulling metal east while Western vaults echo empty. Friday's algorithm dumped billions in shorts, targeting a crush below $62. Yet the price rebounded to multi-year highs, absorbing every contract without flinching. This isn't volatility, it's fracture. Liquidity on the sell side vanished mid-assault, leaving banks like JP Morgan exposed to margin calls that could exceed their commodity desk's cash reserves. The system, designed for control, now reveals its brittleness. A 40-year tactic shattered in hours, signaling the end of manipulated stability. As Asian markets open, a gap up to $75 or beyond isn't speculation. It's mathematical inevitability in a vacuum where sellers refuse to show. Shorts entered the weekend expecting profits. They'll wake to insolvency. Their stop losses leaped over in a single tick. This anomaly didn't emerge in isolation. It's the culmination of pressures building across layers of the system, where financial engineering meets physical scarcity. Consider the options market, bloated to historic volumes. Speculators and hedge funds loaded up on calls at strikes of $70, $75, $80. Banks, as market makers, sold those options, obligating themselves to hedge with futures buys as spot prices climb. Friday's failed smash was their desperate bid to escape this gamma trap, a self-reinforcing loop where their own purchases accelerate the rise, forcing more buys in a vicious cycle. Now, with the price uncoiled, that mechanism ignites. Banks aren't just losing, they're fueling the fire that consumes their positions. The logic breaks here. Institutions built to arbitrage inefficiencies now create them, turning derivatives from tools into liabilities. Peel back further, and you see the geographic rift widening. Shanghai's premium isn't a quirk, it's arbitrage in action. Why ship ore from a Mexican mine to New York at $67 when Eastern buyers offer $78? They won't. Physical flows redirect, draining COMEX inventories that were already strained. Western exchanges play with paper, but the East accumulates atoms. This isn't balanced trade, it's extraction. China's not passive. They're architects, leveraging Western corruption against itself, securing tech metals for the century ahead. Batteries, chips, solar panels. The industrial backbone demands silver, and supply chains calibrated for abundance now face void. Tesla, Samsung, Apple. Their just-in-time models assume perpetual cheapness. That assumption died Friday. Procurement teams scramble, willing to outbid anyone for availability. Price be damned. The market shifts from financial speculation to raw possession, where ownership trumps contracts. If you've tracked commodity flows or work in logistics, how does this eastward pull manifest in your observations? Share your take in the comments. Does it align with what I'm seeing or reveal different fractures? History mirrors this without mercy. Recall 1980, when the Hunt brothers cornered silver, pushing it to $50 amid industrial panic. Back then, the system bent but held. Regulators intervened. Rules shifted overnight to unwind positions. Today, the scale dwarfs that. Shorts held by bullion banks eclipse those levels, not as bets, but as systemic bets against reality. What worked in 80 fails now because the players have multiplied. Retail investors, once scared off by volatility, now hold firm. Friday's dip didn't trigger sales, it triggered buys. The algorithm relied on fear. Fear evaporated. This inversion marks the loss of control. Gatekeepers who thrived on demoralizing weekends now face a mobilized base sensing weakness. Extend that to the broader architecture. Western finance rests on infinite liquidity illusions. Print money, suppress metals, maintain faith in paper. But when a core asset like silver gaps up, it exposes the hollow core. JP Morgan's derivatives book, the largest in history for commodities, isn't investment. It's a wager on perpetual suppression. At $75 billion, billions vaporize. At $100 billion, solvency questions arise. Their desks lack the capital for Monday's margins, explaining the outages rippling through banking networks, glitches masking nakedness. The emperor's exposure isn't metaphor, it's balance sheet reality. If control slips here, it cascades. Gold follows, bonds tremble, currencies question their anchor. The nuclear option looms, unspoken but evident in precedents. 2022's nickel squeeze saw exchanges invoke force majeure. Trades annulled, rules suspended to shield a tycoon. Apply that to silver. Halt trading. Allow only closures. Rewrite overnight. But silver isn't nickel. It's proto-money, a hedge against fiat erosion. Trigger force majeure, and trust erodes globally. Dollars lose luster as markets sense favoritism. Exchanges trap themselves between saving banks and preserving the system's facade. Choose wrong, and the fracture propagates. In your view, does this echo the nickel event more as warning or blueprint? If you've analyzed past interventions, drop your interpretation in the comments. How might regulators pivot this time? Layer in the industrial angle, and the pressure compounds. Tech giants operated under suppressed prices for decades, embedding silver into supply chains without buffers. Now, with mines retracting hedges and sovereign funds hoarding, availability craters. Production lines halt not from cost, but absence. A Samsung fab idles without conductive paste. A Tesla plant stalls sans battery components. This isn't hypothetical. Friday's reversal flipped the switch from abundance mindset to scramble mode. Corporates enter the fray as buyers of last resort, amplifying the squeeze. The system loses stability where finance meets manufacturing. Paper markets detach from physical needs, creating voids that algorithms can't fill. Geopolitics weaves through, unignorable. The East premium pulls not just metal, but power. While West plays derivatives games, Asia builds reserves for strategic tech dominance. This decoupling isn't new. Gold flows showed the pattern years ago, but silver's role in renewables and electronics accelerates it. Mines in Latin America reroute shipments. Refiners prioritize premium payers. Western inventories, already low at under 1 billion ounces deliverable, approach critical depletion. COMEX reports obscure it, but delivery demands spike, revealing the bluff. Private investors catalyze the shift. No longer weak hands folding at the first smash, their conviction holders rejecting the game. The squeeze movement matured. Forms buzz with hold strategies, not panic sells. FOMO replaces fear. Miss the upside, and you're sidelined in the wealth transfer from paper to physical. Millions poised for Monday, their buys overwhelming institutional shorts. The dynamic inverts. Masses overrun gatekeepers, turning controlled markets into uncontainable surges. If you're holding physical or trading futures, what's your read on this retail inversion? Comment below with your experience. Does it feel like 80s redux or something unprecedented? Push the analysis deeper. The gamma squeeze isn't isolated mechanics. It's symptomatic of over-leveraged derivatives ecosystems. Options volumes at records mean every tick upward compels delta hedging. Banks buy futures to cover, driving spot higher, necessitating more buys. Friday's failure locked them in. Escape window closed. Now they chase the price they once dictated. This loop exposes the fragility. Systems built on infinite shorts meet finite supply. Contrast with historical suppressions. Post-2008, central banks flooded liquidity, capping metals to buoy equities. It worked while faith held. Now, inflation scars and tech demands erode that. Silver's dual role, industrial and monetary, amplifies the break. At $100, industrial users pay up or pivot. Monetary holders bunker down. The pivot point. Where suppression tools exhaust, reality asserts. Regulators' silence screams. No statements, no interventions flagged. Yet, in crises past, like 08 bailouts, they moved preemptively. Here, quiet suggests paralysis. Act too soon. Admit weakness. Wait. Risk contagion. Media blackout compounds it. Headlines chase stocks, ignoring metal signal. This omission isn't oversight. It's containment failure. For those in finance or watching regulators, how do you interpret this silence? Share in the comments if it signals complacency or calculated delay. What precedents guide your thinking? Trace back to the weekend setup. Traders short into close expected a demoralized open. Instead, Asian bids flood in, sensing blood. Gap-ups aren't rare in equities, but in commodities, they herald regime shifts. Models project not $67 to $68 continuity, but a discontinuous leap. $75 minimum, $80 probable if industrials pile on. Shorts pain. No time to cover. Margins auto-liquidate at ruinous levels. Broader contagion risks. Silver spike pressures gold, already premium heavy in East. Bonds yield curves invert further as safe havens rotate. Currencies wobble. Dollar strength hinged on suppressed metals. Lose that, and alternatives shine. The system's Achilles. Interconnected derivatives mean one asset squeeze ripples system-wide. Industrials panic adds fuel. Just-in-time chains, efficient in stability, shatter in scarcity. Apple sources silver for circuits. Without, iPhone lines pause. Solar firms like First Solar face panel halts amid green transition irony. Push for renewables starves the metal enabling them. Costs spiral, but shutdowns devastate more. Monday's open sees corporate bids eclipse speculators, turning auction into desperation. If you're in tech or manufacturing, how has silver scarcity hit your operations yet? Drop your insights in the comments. Does it match this systemic view, or highlight localized breaks? Historical parallels sharpen the lens. The 1970s oil shock flipped energy from cheap input to strategic choke point. Silver mirrors that for tech. Then, cartels controlled supply. Now, market forces plus geopolitics do. 80 hunts failed because isolation. Today squeeze distributes across retail, sovereigns, corporates. The difference? Scale and speed. Algorithms accelerated suppression. Now they accelerate unwind. The force majeure specter. Invoke it, and legality overrides market. But for silver, it's Pyrrhic. Destroy trust in exchanges. Accelerate flight to physical. Nickel 22. Saved one player. Cost credibility. Here, protecting JP Morgan risks dollar hegemony. The bind. Short-term salvation. Long-term erosion. Private momentum sustains it. Retail's evolution from 11 flash crash victims to 25 holders breaks the fear cycle. Social coordination. Forms, apps, amplifies buys, turning decentralized force against centralized control. FOMO kicks in at gaps. Miss the train, lose the transfer. Finally, the phase fixes cold. We're mid-unwind, where paper illusions yield to atomic truths. No crash, but liberation. Prices seek equilibrium beyond manipulation. Volatility peaks as systems resist, but the fracture's set. Wealth shifts inexorably from shorts to holders. East gains, West recalibrates. The clock advances. Stability's illusion fades. One last point on this wealth transfer. How do you see it playing out in your portfolio or region? Comment with your perspective. It adds to the collective scan of this break. Silver trades at $69 per ounce today, up from Friday's close near $67, absorbing weekend bids without the dramatic gap once modeled. The rise isn't smooth continuity. It's acceleration in a market already stretched, with COMEX registered inventories depleted by over 60% in early December alone, leaving vaults strained as delivery demand spiked. Physical premiums in Shanghai hold elevated, pulling metal eastward while Western dealers ration allocations. This isn't equilibrium. It's tension unresolved, where paper prices chase reality upward, exposing the disconnect that widened through the year. The mechanism shifted mid-2025. JP Morgan, long the anchor of massive short positions, historically the largest in commodities, unwound its 200 million ounce paper shorts between June and October, flipping to a net long of 750 million ounces, the biggest physical stockpile ever assembled. That reversal removed the primary cap on prices, turning a suppressor into an accumulator. Shorts from peers lingered briefly, but the vacuum pulled everything higher. Industrial users, sovereign buyers, retail holders all bidding into scarcity. The gamma dynamics persist in remnants. Options chains still bloated, forcing hedging buys that feed the move. But the core driver now is absence, not force covering. Banks didn't collapse. One adapted, dominating instead, controlling near 40% of deliverable supply and amplifying tightness. Industrial chains reveal the depth. Solar, EVs, data centers consumed near record volumes in 2025. Deficits running 5 years straight, projected to continue into 2026. Thriving occurred. Substitutions minimized impact, but at premiums that reroute flows. Mines hedged less. Refiners prioritized higher bidders. Latin American output diverts east. COMEX stocks, once bloated, drained rapidly when arbitrage flipped. The system holds, yet operates at capacity limits, where any disruption risks halts. Tesla lines didn't stop en masse. Samsung fabs adapted, but procurement shifted to forward contracts at escalating costs, embedding inflation into tech. If you source silver from manufacturing this year, how tight did allocations become in the final quarter? Share your observations in the comments. Does the premium pain match broader reports or expose regional variances? Geopolitics layered the pressure without overt crisis. Rate cuts resumed, safe haven flows strengthened amid tensions, but no single event triggered force majeure. Exchanges monitored, yet refrained. Nickel precedents loomed, but silver's monetary undertone deterred intervention. Invoking emergency clauses risked broader trust erosion, accelerating flight to physical. Regulators observed silence through the surge, containment through inaction. Media focused elsewhere. Equities, crypto. But metals signaled quietly. Dollar anchors tested as alternatives accumulated. Retail participation evolved further. Conviction buyers dominated dips. FOMO sustained momentum, but without the chaotic squeeze of prior attempts. Coordinated holds turned into steady accumulation, overwhelming residual shorts gradually. The inversion completed. Fear of missing upside overrode fear of volatility. Masses dictating pace where gatekeepers once demoralized. For those trading or holding through this phase, What's shifted in sentiment on forums or platforms? Comment with your read. Has it stabilized into acceptance or built toward another leg? Derivatives ecosystems adjusted painfully. Open interest swelled, then contracted as positions unwound. Volatility spiked, but contained within uptrends. The loop, rising spot compelling delta hedges, fueling more rise, played out, but with dominant longs absorbing rather than panicking. Solvency stresses emerged in fringes. Smaller desks margined out, but systemic players repositioned. JP Morgan's hoard buffered, turning potential liability into leverage. History reflects the pivot coldly. 1980s corner failed amid isolation and intervention. Today's distributed across institutions, states, corporates, individuals. No single choke point for regulators to sever. 2022 nickel saved one entity at credibility cost. Here, no equivalent trigger materialized. Suppression eras post-2008 relied on liquidity floods and capped metals. Now, demand outruns, deficit structural. The silence from overseers persists as telling signal. No flagged interventions, no public warnings, paralysis or acceptance. Precedents like bailouts move fast. Here, quiet allows rebalancing, perhaps recognizing shifted fundamentals. If you followed regulatory signals in commodities, how does this quiet compare to past tight markets? Drop your analysis in the comments. What might tip the balance next? Contagion touched gold, bonds adjusted yields, but currencies held without fracture. Dollar strength waned marginally as metals rose, yet no hegemony crisis. East's accumulation strategic, securing tech inputs without confrontation. Premiums normalized somewhat as flows adjusted, but eastward bias endures. Corporate bids intensified late year, outbidding specs for security. Just-in-time fragility exposed, buffers built quietly. Green transition irony. Renewables demand starving enabling metal, costs spiraling, yet deployment accelerating. In tech supply chains, where has scarcity bitten hardest? Solar, batteries, electronics? If you're inside, comment on adaptation seen. Does it foreshadow broader constraints ahead? The phase solidifies. Unwind largely complete, prices liberated into discovery mode. Volatility tempers as new levels digest, but upside bias intact on deficits. Wealth transferred. From lingering shorts to holders, paper to physical, west to east recalibration. No terminal explosion, but sustained elevation. System adapting to scarcity it long denied. Equilibrium higher, fragility embedded, where abundance assumed perpetual. One final scan on this rebalancing. How has it reshaped your view of metals in portfolios? Share in the comments. Collective signals clarify the ongoing shift. Silver touches 6 gram per ounce today, hitting a fresh all-time high of 6 gram.44 in intraday trading before settling near 6 gram.18. This isn't a fleeting spike. It's the culmination of a 13% annual surge, the strongest since 1979, with December alone delivering repeated records. COMEX registered inventories drained sharply earlier in the month, over 47 million ounces claimed in the first days, exposing vaults that couldn't refill fast enough. Shanghai premiums lingered elevated through the year, redirecting flows while Western dealers faced rationing. The market didn't explode in a single gap. It ground higher, absorbing bids relentlessly, revealing a system no longer suppressing but chasing physical reality. The pivot crystallized mid-year. JP Morgan unwound its historic 200 million ounce paper short between June and October, flipping to a net long of 750 million ounces, the largest physical hoard ever assembled by one entity, commanding near 40% of deliverable COMEX supply. That removal of the perennial downward force unleashed the climb. Residual shorts from others evaporated under pressure. Industrials bid aggressively, sovereigns accumulated quietly. Gamma remnants fueled hedging buys, but the dominant mechanism became scarcity itself. Deficits running 5 years straight, projected into 2026, with industrial offtake hitting records despite thrifting attempts. Solar and EVs anchored the demand surge. Photovoltaics consumed massive volumes, each panel relying on silver's conductivity, while electric vehicles doubled usage per unit over combustion engines, 25 to 50 grams apiece. Data centers and electronics compounded it, pushing total industrial demand near peaks even as prices soared. Chains adapted, substitution slowed rollout impacts, forward contracts locked in at premiums, but availability dictated terms. Procurement shifted from cost optimization to security, embedding higher baselines into tech pricing. If you're in renewables or automotive sourcing, how have these deficits reshaped your 2025 contracts? Comment with specifics, premium levels, allocation fights, or substitution limits seen on the ground. Geopolitics amplified without direct confrontation. Rate cuts resumed. Safe haven bids strengthened amid sanctions and tensions, but no force majeure materialized. Exchanges watched tightness. London vaults depleted sharply earlier, lease rates spiking, but refrained from intervention. Nickel precedents deterred. Silver's dual monetary industrial role made emergency rules riskier, potentially eroding trust faster than resolving strains. Regulators' quiet persisted, neither endorsing nor halting the revaluation. Retail evolved into sustained force. Conviction overtook speculation. Dips met buys, FOMO entrenched as records fell. Coordinated accumulation overwhelmed paper overhangs gradually. No chaotic corner, but distributed pressure from millions holding through volatility. For those accumulating physical this year, what's changed in dealer dynamics or premium structures? Share your observations below. Has it stabilized or signaled deeper shifts ahead? Derivatives adjusted amid pain. Open interest ballooned, then contracted on unwinds. Volatility contained within uptrends. Dominant longs like JP Morgan buffered, turning positions into control rather than vulnerability. Smaller players margined out, but systemic cores repositioned, leveraging the flow. History echoes the transition. 1979 to 80 saw explosive gains amid inflation in corners. Intervention capped it. Today's distribution, across corporates, states, retail, lacks single points for severance. Post-2008 suppression leaned on liquidity and caps. Now structural deficits from tech demand override. Oversight silence marks acceptance or constraint. No preemptions, no warnings, allowing fundamentals to assert over-engineered stability. If tracking oversight in metals, how does this inaction align with prior deficits? Drop your parallels in comments. What thresholds might force response next? Contagion reached gold, yields adjusted, currencies held firm, marginally weaker dollar as alternatives rose. East's strategic buys secured inputs. Premiums eased on adjusted flows, but bias endured. Corporates intensified late-year bids, building buffers against just-in-time breaks. Green irony persisted. Transition demand constraining enablers, yet deployment accelerated. In electronics or energy chains, where did tightness manifest most? Panels, batteries, grids? If inside, comment on workarounds. Do they hint at 2026 constraints? The reconfiguration sets. Suppression exhausted. Prices in prolonged discovery. Volatility moderates on digestion. Upside persistent on deficits. Transfer completed. From suppressed paper to elevated physical, lingering suppressors to accumulators. Regional recalibrations. No abrupt terminus, but embedded elevation. System conceding to scarcity, long masked. Final gauge on this elevation. How has it altered metal's role in your strategic view? Comment your repositioning. Layered perspectives sharpen the ongoing map.